4 engines out of 33 don't fire. And that's it. The whole countdown just stops. Both stages still bolted to the pad.
No launch at all.
No launch. The rocket's own abort system caught it at T0. And the next morning, the stock most tied to that rocket falls another 4%, closing below the price it went public at for the first time in its short life.
The largest IPO in history, and within weeks, it's underwater.
$85.7 billion raised on June 12th, and by mid-July, trading below the offer.
So, set the scene. This was Starship's 13th test flight.
13th flight, but only the second of the upgraded V3 configuration. And critically, the first launch attempt since SpaceX went public on June 12th. On the evening of July 16th, 4 of the 33 Raptor engines on a Super Heavy booster failed to ignite. Automatic abort. SpaceX said they'd offload propellant and investigate. The CEO said 2 Raptors get pulled and replaced, targeting a relaunch early the following week.
And the stock was already sliding before this.
Already going down. SPCX priced at $135 a share, June 12th. It ran up, intraday high of $225.64. Then a sustained descent. It first cracked below $135 intraday on July 15th, closed below on the 16th, and fell further on the 17th after the abort news. Business Insider pegs the drop from its June 16th peak at roughly $1 trillion in market cap.
$1 trillion.
And CNBC reported it was down nearly 23% just since joining the NASDAQ 100 on July 7th.
We'll come back to that index piece, because that's stranger than it sounds. Help me understand why a scrubbed test flight moves a company valued near $1.8 trillion. Rockets fail tests. That's what tests are for.
Right? And normally a scrub is nothing. But here's the mechanism. SpaceX's only profitable segment is Starlink, and Starlink needs satellites replenished. The newest, third-generation Starlink satellites are designed to ride to orbit on exactly this vehicle, V3 Starship. 20 of them were aboard this flight.
So the rocket that's grounded is the delivery truck for the one business making money.
That's the chain. Every additional month Starship sits on the ground isn't just a bad headline. It's a direct constraint on the revenue growth rate that's supposed to justify the valuation. And the numbers underneath are heavy. Fiscal year 2025, a net loss of about $4.9 billion on $18.7 billion in revenue. First quarter of 2026 alone, the net loss widened to $4.3 billion.
Widened in a single quarter.
On $4.7 billion in revenue for that quarter. So the story investors are buying isn't today's profit. It's Starlink growth plus the moonshots, the NASA Artemis lunar lander, where SpaceX holds about $4 billion in contracts, and this stated ambition to build orbital data centers. All of it flows through Starship cadence.
And the flight record on V3 specifically?
Thin and shaky. The first V3 flight in May deployed Starlink simulators, but the booster failed before its simulated landing. That triggered an FAA review that grounded Starship for 2 months. They cleared it earlier this week, and then this abort.
So, the NASDAQ 100 thing. Walk me through why that's the odd part.
SpaceX joined the NASDAQ 100 on July 7th, just 15 trading days after its debut. That's astonishingly fast, and it only happened because NASDAQ adopted a fast-track inclusion rule back in May 2026.
And inclusion forces buying.
Every fund benchmarked to that index has to hold the stock. Market analysts estimated $4.3 billion or more in mandatory passive buying from index tracking ETFs.
And yet, the stock kept falling.
That's the counterintuitive part. You'd expect billions in forced demand to hold a price up. It didn't. The stock fell through all of that, which tells you the selling pressure on the other side was heavier than $4+ billion of index money.
And those index funds bought at what level?
Near $162 at the July 7th rebalancing. That's roughly 20% above where it trades now. So, every QQQ-type investor who tracks that index is sitting on an immediate loss they didn't choose. They were mechanically forced to buy near the top.
They didn't pick the stock. The rule picked it for them.
And here's the contrast that makes it sharper. S&P Dow Jones indices looked at the same fast-track idea in June and rejected it. They kept their profitability requirement, so S&P 500 funds hold zero SpaceX. Under existing rules, the S&P won't touch it until at least mid-2027. That whole wave of passive money is a future catalyst, not a present one.
So one index rulebook manufactured buyers into a loss, and the other rulebook spared its investors entirely.
Same company, two committees, opposite outcomes for the people holding the funds.
What about the underwriters? Goldman, Morgan Stanley, BofA, Citi, JP Morgan. They priced this.
They're in a genuine bind. Consensus analyst price targets, pre-decline, sat around 188.57. That's more than 40% above where the stock trades now.
So the targets are stranded.
Stranded and visible. Either they publish aggressive target cuts on the largest IPO they've ever managed, which stings, or they defend a $180 target with no earnings data to point to on a stock trading under the offer price they set. There's no clean exit. And JP Morgan in particular is exposed because that $4.3 billion passive inflow estimate was widely attributed to them. If the stock's still below IPO price at the lockup trigger, people will revisit that number.
Who else is caught in this?
Start with the FAA. It cleared Starship to fly again earlier this week after its 2-month review of the May booster failure. A fresh engine failure event like this abort could pull it back into another review. And that's the thing that could stretch the grounding past the CEO's early next week target.
The regulator can override the relaunch date.
Then, the NASDAQ 100 ETF holders we discussed? Forced buyers near 162, now marked down. Retail investors next, and this one's striking. Retail got about 30% of the IPO allocation, unusually large for a megacap. Many held through that 225 peak and are now well underwater.
30% to retail is enormous.
It is. Then Starlink's competitors, Amazon's Kuiper, OneWeb, and Eutelsat, get a small gift because the abort delays those 23rd generation Starlink satellites that were meant to start validating inter-satellite links. Blue Origin sits in a double competition against SpaceX on the Artemis lunar lander, and more broadly, though Blue Origin has its own launchpad explosion that pushed New Glenn to at least the fourth quarter. Then, space sector ETFs, especially South Korean funds, names like ACE US Space Tech, Codex US Aerospace, Tiger US Space Tech, Seoul US Aerospace, all carrying SpaceX exposure and reporting losses. And finally, S&P Dow Jones Indices, the committee that said no, and for now, looks vindicated.
NASA's in there too.
NASA's the quiet one. This is the second consecutive Starship setback. May booster failure, then this July abort. Their confidence interval on near-term reliability just contracted twice. The open question is whether they still have schedule margin for the Artemis 3 crew docking rehearsal, or whether they have to formally notify Congress of a slip.
What's genuinely unknown here?
The big one. SpaceX has no public earnings history. This first quarterly report will be both the fundamental baseline and the trigger for a partial lockup. Active managers have no prior numbers to defend a position with. They're flying blind on the exact figure, Starlink subscriber growth, that the whole thesis rests on.
And the lockup.
Employees and early investors can sell 20% of their holdings after that first earnings report. Timing's described as low hundreds of days post-IPO. The record doesn't pin an exact date. If earnings and insider selling land together, the message gets muddy. A widening loss printed the same week supply hits the market.
What do we watch?
First, a formal go or no-go on the relaunch. The CEO said 2 Raptors get swapped early next week. That announcement is the single most watched near-term signal. Second, whether the FAA opens a fresh review, that's what extends the grounding. Third, SPCX at the Monday open relative to 135. Sustained trading below the IPO price confirms this isn't a blip. And fourth, the date SpaceX sets for its first earnings report. That one line clarifies both the disclosure timeline and the lockup trigger.
Bottom line it.
The stock is priced on a rocket, and the rocket didn't leave the pad. Until Starship flies clean, and Starlink's real numbers are public, everything about this valuation is a promise the market's no longer taking on faith.
This episode is grounded in a world-by-flow analysis, drawing on 24 web sources,